When most people hear market crash, they imagine panic and financial devastation. But here's what history books leave out. Every major crash has been followed by the greatest wealth transfer of its era. The crashes didn't destroy wealth. They simply moved it from the unprepared to those who understood what was happening. After the 1929 crash, investors who bought quality assets during the Great Depression saw extraordinary returns. When the dot-com bubble burst in the early 2000s, patient investors who accumulated undervalued stocks watched their portfolios multiply tenfold or 20-fold over the following decade. The 2008 financial crisis marked the beginning of the longest bull market in American history. Now, as we approach 2026, warning signs are flashing across multiple economic indicators. If historical patterns hold true, what's coming will represent a fundamental reset of asset valuations. Those who position themselves correctly could profit immensely. The question isn't whether you'll survive the next crash, but whether you'll be positioned to benefit from it. The crash of 1929 and subsequent Great Depression represent the most severe economic contraction in modern American history. The Dow Jones lost 89% of its value from peak to trough. Unemployment reached 25%, and thousands of banks failed. But beneath this catastrophe, massive wealth transfer occurred. Investors who maintained liquidity and purchased quality stocks in 1932 and 1933 achieved seemingly impossible returns. Companies like General Electric and IBM traded at fractions of their actual value. The dot-com crash provides an even clearer example. The Nasdaq fell 78% from March 2000 to October 2002. Hundreds of internet companies went bankrupt, and trillions in paper wealth evaporated. Yet this created generational buying opportunities. Amazon stock fell from over $100 to as low as $6. Investors who recognized Amazon's dominant position and bought during this period saw returns exceeding 5,000% over 2 decades. Apple traded below $10 per share on a split-adjusted basis. Google went public in 2004 at reasonable valuations precisely because the crash had reset expectations. The 2008 financial crisis demonstrated the pattern again. The housing market collapsed, major institutions failed, and the Standard & Poor's 500 lost 57% of its value. Unemployment reached 10%. But March 2009 marked the beginning of an 11-year bull market that saw the Standard & Poor's 500 more than quadruple. Real estate investors who purchased foreclosed properties at 30 to 50 cents on the dollar built enormous wealth. Bank stocks trading at crisis valuations delivered returns exceeding 300% over the following decade. Multiple economic indicators suggest we're approaching another major inflection point. The Shiller cyclically adjusted price-to-earnings ratio, which measures how expensive stocks are relative to their 10-year average earnings, currently sits at its second highest level in recorded history. The only time it was higher was in 1999, immediately before the dot-com crash erased trillions in market value. This metric matters because it measures whether current stock prices are justified by actual corporate earnings or whether they're inflated by speculation and easy money. When the Shiller PE ratio exceeds 30, which it does today, historical data shows that forward 10-year returns for stocks average close to zero. When it exceeds 40, as it did in 1999, subsequent crashes have exceeded 50%. Total household debt in the United States has surpassed $17 trillion, a record high that exceeds even the debt levels seen before the 2008 crisis. Credit card debt alone has reached $1 trillion, with average interest rates exceeding 20%. Student loan debt stands at $1.7 trillion. Auto loan debt has surpassed $1.5 trillion. Consumer spending, which drives 70% of the United States economy, is increasingly dependent on borrowed money rather than actual income growth. Corporate debt presents an even larger concern. United States corporate debt has reached over $12 trillion, with a significant portion rated as BBB, the lowest tier of investment-grade bonds. During economic stress, many of these bonds will be downgraded to junk status, triggering forced selling by pension funds and insurance companies that can only hold investment-grade securities. This creates a self-reinforcing cycle where credit spreads widen, refinancing becomes impossible, and previously healthy companies face bankruptcy. Government debt has exploded past $35 trillion, representing over 120% of gross domestic product. Annual interest payments on this debt now exceed $1 trillion, consuming a larger portion of the federal budget than defense spending. As interest rates remain elevated to combat inflation, these debt service costs will continue growing, creating a mathematical problem that has no easy solution. Economic crashes follow predictable patterns driven by human psychology and mathematical inevitability. Throughout modern history, the United States has experienced major financial crises roughly every 18 to 20 years. 1929, the 1970s stagflation crisis, the 2000 dot-com crash, 2008's financial crisis, and if patterns hold, 2026. These cycles are driven by the credit cycle. During good times, lending standards loosen, debt levels rise, and asset prices inflate. People assume rising prices represent a permanent new paradigm. Eventually, debt reaches unsustainable levels. Some triggering event exposes the imbalance, confidence evaporates, and the system contracts violently. The mathematical reality is straightforward. When debt grows faster than the economy's ability to service it, something must give. Either the debt gets inflated away through currency debasement, or it defaults, transferring assets from borrowers to lenders at distressed prices. Current conditions suggest we're in the late stages of a credit expansion that began after 2008. The Federal Reserve's balance sheet grew from under $1 trillion in 2008 to over $9 trillion at its peak. This massive monetary expansion inflated asset prices across every category to valuations that would have seemed absurd a decade earlier. While mainstream financial media tells retail investors that everything is fine, institutional money managers are positioning for a very different future. Warren Buffett's Berkshire Hathaway is currently sitting on over $325 billion in cash and short-term treasury securities, the highest amount in the company's history. Buffett, who famously said to be fearful when others are greedy and greedy when others are fearful, has been a net seller of stocks for multiple quarters, suggesting he finds current valuations unattractive. If you're enjoying this analysis of how market crashes create wealth, make sure to subscribe for upcoming videos where we'll dive even deeper into specific investment strategies and historical case studies. Major hedge funds have been quietly building positions in gold, silver, and other precious metals. Central banks around the world, particularly in China, Russia, and other emerging markets, have been accumulating gold reserves at the fastest pace in decades. This suggests these sophisticated institutional investors see trouble ahead for paper currencies and are positioning in assets that have maintained value through every previous financial crisis. Real estate investment trusts focused on high-quality properties have been raising cash reserves and paying down debt, preparing their balance sheets for potential acquisition opportunities. Private equity firms are accumulating dry powder, the industry term for committed capital that hasn't yet been invested. These firms know that the best deals happen when other investors are forced to sell during credit crunches and economic panics. Crashes don't destroy wealth, they transfer it. The economy's productive capacity, factories, farmland, office buildings, technology, and skilled workers don't disappear during financial crises. What changes is ownership. Assets move from weak hands to strong hands, from the over-leveraged to the liquid, from emotional investors to rational ones. During 2008, millions lost homes to foreclosure. But those homes didn't vanish. Investors with cash purchased them at 50 to 70% discounts from peak prices. Investors who bought residential real estate in Phoenix, Las Vegas, and Miami during 2009 and 2010 saw properties double or triple in value over the following decade while generating rental income. The stock market followed the same pattern. Bank of America traded as low as $3 per share during the crisis, recovering to over $30 within 5 years. The company never stopped operating, never stopped having millions of customers. What changed was the price at which ownership shares could be acquired. Investors who bought during panic achieved returns exceeding 1,000%. The key insight: fear creates history's best buying opportunities. When everyone else desperately sells, when financial media predicts apocalypse, when neighbors panic, that's precisely when quality assets become available at seemingly impossible prices. Investors who profit from crashes aren't lucky or particularly smart. They're simply disciplined enough to act when action feels most dangerous. The coming crisis will fundamentally differ from 2008 inches. One crucial way: we're entering it with government debt levels that leave little room for massive fiscal stimulus. In 2008, federal debt stood at $10 trillion. roughly 65% of gross domestic product. Today, it exceeds $35 trillion, over 120% of GDP. When the next recession hits, government response will be constrained. Interest rates are already elevated fighting inflation. Federal deficits run over $2 trillion annually during supposedly good times. When tax revenues fall and unemployment benefits rise during recession, deficits will explode to levels that may test confidence in United States Treasury securities. Corporate debt deserves special attention. Years of near-zero rates allowed companies to borrow enormous sums at minimal cost. Many loans now need refinancing at interest rates 3, 4, or 5 times higher than original borrowing costs. Companies that seemed healthy paying 2% interest may face bankruptcy when refinancing at 8 or 10%. Commercial real estate faces acute stress. Office buildings financed on pre-pandemic occupancy assumptions sit partially empty as remote work has permanently reduced demand. Many properties generate insufficient cash flow to service debt at current rates. Banks holding these loans will face significant losses as properties are foreclosed and sold at discounts. Positioning yourself to profit requires completely reversing normal investor behavior. Most people buy when prices are high and optimism peaks, then sell in panic when prices collapse. This backward approach guarantees they'll be on the losing side of every wealth transfer. First, build cash reserves now while asset prices remain inflated. This feels wrong because cash loses purchasing power to inflation and generates minimal returns compared to stocks during bull markets. But cash provides liquidity to purchase assets when forced sellers dump quality holdings at any price. How much is enough? History suggests holding 20 to 40% of your investment portfolio in cash or short-term treasury securities provides enough purchasing power for crisis opportunities without missing too much ongoing bull market gains if the crash takes longer than expected. Second, identify quality assets that will be valuable regardless of economic conditions. These are companies with strong balance sheets, minimal debt, consistent earnings, and products people need during recessions. Think consumer staples, utilities, healthcare, and technology businesses with actual profits rather than speculative growth stories. Research these companies now, understand their business models, calculate their worth based on conservative assumptions, and determine what price represents a genuine bargain. Then wait. When crash-driven panic selling drives prices down, you'll know exactly what to buy and at what price, eliminating emotional decision-making that causes most investors to freeze during crises. Not all assets perform equally during financial crises. Understanding which categories preserve value or even appreciate during chaos helps focus preparation efforts. Quality businesses with pricing power represent the gold standard for crisis investing. Companies providing essential goods or services with low debt and consistent cash flow maintain profitability as the broader economy contracts. They often emerge stronger because weaker competitors disappear, allowing market share gains and price increases. Real estate requires careful analysis because location and property type matter enormously. Prime residential real estate in desirable areas maintains value better than marginal properties. Single-family homes generally outperform apartments during stress. The key is identifying properties that remain useful and in demand regardless of conditions. Precious metals serve different functions than growth assets. Gold and silver don't generate earnings or cash flow, so they're not traditional investments. They're insurance against complete breakdown of paper-based financial systems. During 2008, gold increased in value even as nearly every other asset declined. Treasury securities, particularly short-term bills, provide safe parking for capital during uncertain times. While long-term bonds carry interest rate risk, short-term treasuries offer liquidity and safety backed by the United States government. Perfect for holding cash reserves, you'll eventually deploy into higher returning assets once crisis creates genuine bargains. Timing a market crash perfectly is impossible, but you don't need perfect timing to profit. What matters is having a systematic approach that positions you to benefit whether the crash comes sooner or later. Dollar cost averaging with a twist works well. Instead of investing the same amount monthly regardless of conditions, adjust your investment rate based on valuations. When the Shiller PE ratio is above 35, as now, reduce stock purchases and accumulate cash. When it falls below 20 during a crash, accelerate purchases and deploy cash reserves. This approach builds liquidity during expensive markets and deploys it during cheap ones, exactly opposite of what emotional investors do. It requires discipline and patience, but the mathematics work in your favor over complete cycles. The psychological challenge cannot be overstated. During the build-up phase, you'll watch friends making paper profits while your conservative positioning lags the market. Social pressure to participate will be intense. Financial media will proclaim new paradigms. Staying disciplined will feel like missing out. Then, when the crash arrives, every instinct will scream preservation of remaining cash. Financial media will predict capitalism's end. Your social circle will panic. Fear will be overwhelming. This is exactly when you need to act. Investors who bought during 2008 and 2009 depths weren't lucky. They were disciplined enough to execute their plan when it felt most dangerous. True wealth multiplication comes not just from buying during crashes, but from compound returns generated during subsequent recovery. This combination creates outcomes that seem impossible during normal market conditions. Consider the mathematics. An asset purchased at a 50% discount that recovers to normal valuations provides a 100% return. An asset purchased at a 70% discount provides a 233% return when it recovers. These represent actual returns achieved during every major crash by investors who had capital and courage to buy quality assets at distressed prices. But real wealth creation comes from reinvesting crisis gains during recovery. Investors who doubled their money buying stocks in 2009 and then used those gains to purchase more stocks as the bull market continued achieved returns that transformed their financial lives. The combination of crisis buying and recovery compounding is how middle-class investors become wealthy and wealthy investors become rich beyond original dreams. This mathematical advantage explains why crashes don't destroy wealth for the prepared. They concentrate it. Assets don't disappear, they just change hands. Those who position themselves correctly maintain liquidity when others are over-leveraged, act rationally when others panic, and hold quality assets through recovery. These are the people who build generational wealth. The 2026 crash, if it comes as economic patterns suggest, won't be random bad luck. It will be the mathematical consequence of debt levels, asset valuations, and credit conditions built to unsustainable levels. The opportunity it creates will be equally predictable for those who understand the pattern and position themselves accordingly. Start building cash reserves now, even though it feels like missing out on market gains. Research quality companies and assets you'd want to own at the right price. Determine what those right prices would be. Eliminate or reduce your debt so you're not forced to sell at exactly the wrong time. Develop emotional discipline to act when action feels most dangerous. The crashes of 1929, 2000, and 2008 created the greatest wealth transfer opportunities in their eras. The prepared profited enormously, while the unprepared suffered. The coming reset will be no different. The only question is which side of the transfer you'll be on. History doesn't repeat, but the patterns are unmistakable. The mathematics don't lie. The opportunity is building now, hidden beneath economic conditions most people don't understand. Those who prepare will profit. Those who don't will wonder, years from now, how they missed the chance of a lifetime. The next great wealth transfer is coming. Make sure you're positioned to benefit from it.